Hi everyone. So we're starting with the next topic on in financial market. We're talking about money market. If you remember when we did the classification in the previous video, we talked about money market, capital market. Money market is short-term funds market and capital market is long-term funds, deals with long-term funds. And capital market is further divided into primary and secondary, but money market deals in short-term funds, that is up to 1 year. Now, when we talk about money market, we need to understand the features of money market. We need to understand the participants as well as the instruments of money market. Coming to the definition, money market is a market for short-term funds which deals in monetary asset whose period of maturity is up to 1 year. So, 1 year maturity period, all those instruments which we deal with and are up to 1 year are dealt in the money market, in the money market, and they are called money market instruments. Features. It is a market where low risk unsecured short term debt instruments which are close substitutes of money are dealt with. So first thing we are dealing with is low risk, not risky at all. Unsecured. You don't keep anything as a security, no mortgage. Short term, up to 1 year. Debt. Basically we are dealing with debt instruments. So we are not dealing with anything else, but we are dealing with debt instruments. That means we are talking about the udhari, we are talking about the debt, borrowing. Debt instruments which are close substitutes of money are dealt with. So they are close substitutes of money. Why close substitutes of money? Because they are highly liquid, can be converted into cash within no time. Highly liquid, same thing, no physical location, can be done over internet or phone, enables raising short-term funds for meeting temporary cash shortages, usually it's for working capital requirements, enable temporary deployment of excess funds. So if in case you have excess funds, where should you put if you want to put it for a shorter period? Of course, in the money market. Now, you'd say, ma'am, money market is something like we have different markets in different places, like in Ludhiana we have a special market called Saravanagar market. Similarly, do we have money market somewhere where we can go and buy and sell money or do something like that? No, no. No physical location, it's done only through phone and internet. Money market, no physical location. When you talk about the in the capital market, you talk about the secondary market, physical location is there. You see a stock exchange, we have stock exchanges. But when we talk about money market, there is no physical location, it is done on over phone or internet. Get it very clear. Nowhere there are there's money hanging or the instruments are hanging and you go and just bargain for that and you buy it. You don't do like that. Okay. Major participants are RBI, Reserve Bank of India, commercial banks, NBFCs, state governments, large corporate houses and mutual funds. That's what we deal in when those organizations which participate in money market are the following. Now, how do we go? NBFCs, non-banking financing corporations. Instruments of money market are call money, treasury bills, then you have commercial bill, commercial papers and certificate of deposits. We are starting with the first instrument of money market. It is known as call money. Now, meaning is that it is the method by which bank borrow from each other to be able to maintain minimum cash balance, that is CRR, cash reserve ratio as required by RBI. This is bank A, this is bank B, this is shorter funds, this has surplus. The bank borrows from the bank B. Purpose is what? To maintain CRR. CRR is usually sometimes checked by the auditors, and at that time banks need the fund. So it's better to maintain their reputation and to continue with their goodwill. They need to have that kind of CRR without letting the others know that they do not have enough cash reserves or cash balance. Tenure, when we talk about, it is for short-term finance from 1 to 15 days. 1 day is known as call money, more than 1 day till 15 days it is known as notice money. Anyhow, we call it call money in totality. Purpose, commercial banks have to maintain minimum CRR. CRR changes from time to time by RBI, which affects the funds availability for loans by commercial banks. So they borrow from the other bank just in order to maintain their CRR. This is the purpose. Exclusive features. Now, when you talk about call money, it is interbank transaction. Remember, between two banks, no public, nobody else, no companies involved. Repayable on demand. The moment company B will ask for the money, company A has to, the moment bank B asks for money, bank A has to give the money immediately back. Interest rate on call money loans is known as call rate. It is known as call rate. Why is it known as call rate? Because the money is being charged on the call money. So it will be called as call rate. Then next is benefit to market. What is the benefit of call money to the market? A rise in call money market makes money market, other money market instruments cheaper. You know what happens is, the moment there is a rise in call money, so what happens? Whatever the other money market instruments are, like treasury bills, certificate of deposit, commercial bills, commercial papers, they become comparatively cheaper, reasonable. So this is the benefit to the market, and this is a inverse relationship. This is what is called inverse relationship in the call money and the other money market instruments. So I can always write out here, it is the inverse relationship. This is what is called as the inverse relationship. Right. I hope the call money part is clear to you. Next we come to is treasury bill. Right. Like I said, next we are going to talk about treasury bills. What are treasury bills? Treasury bills are issued at discount and redeemed at par. These are also known as zero coupon bonds. What do we mean by issued at discount and redeemed at par? Suppose you want to buy a treasury bill, and you buy a treasury bill, and that these are in multiples of 25,000. So you want to buy 4 treasury bills, that will cost you 1 lakh of rupees. The company issues you the same at 96,000. But after the maturity period, the company pays you back 1 lakh. So these were issued at discount, 96,000, redeemed at par at the same value what they would have been actually for, or what they were actually for. Coming to treasury bills, it is an instrument of short-term debt issued by RBI on behalf of Government of India to meet its short-term requirements of fund. Of course, yes. So RBI involvement is there. These are also known as zero coupon bond issued by RBI on behalf of the central government. Tenure, these are issued in form of promissory note having a maturity period of less than 1 year. Usually it's 14 to 364 days. So amount we talk about, these are available for minimum amount of 25,000 and its multiples. Then we talk about its exclusive feature. This I've already explained to you. The difference between the price at which treasury bill are issued or is issued and their redemption value is the interest receivable on them and is called discount. So the same is the interest and same is the discount. They do not pay interest but are issued at lower price than their face value. So they are lesser than the face value, which are then repaid at par. Par means at the same value. Suppose an investor purchases 91 days treasury bill with face value of 1 lakh for 96,000. Now by holding bill till maturity date, the investor received 1 lakh. That means this is the discounted price. This is issued at discount, redeemed at par. It got redeemed at par. This is at par because this was the face value and this was issued at this price, that is issued at this discount issued. Right. Now this difference 4,000, it can be considered as discount or interest, both whatever way we take it. So what are treasury bills? Very they are not secured, but otherwise yes, they are basically a debt instrument issued by RBI. So they are quite safe. And as it is your money market is highly liquid and less risky, money gets converted into cash within a year. So it is a better place to invest your money into. Alright, next we come to the certificate of deposit. What is certificate of deposit? Before knowing that, usually students ask me, ma'am, what is the difference between certificate of deposit and fixed deposit? Both are same. Their rate of interest is more than the savings account. The only difference is that one is negotiable and the other is not negotiable. So the money market instruments are highly negotiable. That is the certificate of deposit. Are unsecured. Unsecured means no security is required. Negotiables, short-term instruments, bearer and form issued by commercial banks and development finance institution. So these are issued by banks they are issued at the time of tight liquidity, when there's recession or depression. You know what happens is, at that time, what happens is deposits are comparatively less and demand for credit is very high. So these banks issue certificate of deposit, people buy certificate of deposit, and when bank gets enough of funds to carry on its activities. Tenure is 91 days to 1 year. Exclusive feature is it can be issued to the individuals, corporations and companies, and usefulnesses are used during the period of tight liquidity. That is when deposit growth of bank is less and demand for credit is high. So we just discussed treasury bill and certificate of deposit. Next we are going to talk about is commercial banks, which we've done so many times, and then the commercial paper. So starting with commercial bill is just like your bill of exchange which you did in your +1 accountancy. There are two parties, one is seller, one is buyer. Seller sells a good, buyer says I don't have any money. So seller draws the bill of exchange, buyer accepts it and gives it back to the seller. How this becomes a trade bill or a commercial bill and for how long is it, we'll just come to know with commercial bill. When goods are sold on credit, the buyer becomes liable to make payment on a specific date in future. Seller is the drawer of goods and draws a bill. The buyer is the drawee who accepts the bill. On being accepted, the bill becomes a marketable instrument and is called trade bill. The moment it gets accepted, it becomes a trade bill. And when the bill is accepted by commercial bank, it becomes a commercial bill. As simple as that. Of course, knowing you already know it, that it can be discounted with bank. Why? Because whenever the seller is in urgent need of money, it can go to the bank and get it discounted. So we have here as exclusive feature, it can be discounted with bank, and the tenure is usually 3 months, and the purpose is for the working capital requirement. So this is about commercial bill. Next we talk about is commercial paper. Commercial paper is what? Very highly credit rated companies or credit worthy companies issue commercial bill. Companies like Reliance or the kind of companies which sometimes need working capital finance, they need it for the working capital. That is the reason at that time they issue a commercial paper for the purpose of getting the working capital or filling the working capital requirement. Now when we talk about commercial paper, we say it is a short-term unsecured promissory note having a fixed period issued by large credit-worthy and financially strong companies to raise short-term funds at lower rate of interest than market rates. What is the purpose behind raising this fund? The purpose is, like I told you, working capital requirement or sometimes to meet the flotation cost, right? When it talks about the flotation cost, that flotation cost is known as bridge financing. So main purpose of commercial paper is to provide short-term funds for seasonal or working capital needs. An exclusive feature is funds raised through commercial paper are used to meet flotation costs. This is called bridge financing, and of course these are also sold at discount and redeemed at par. Like sold at discount means lesser price and redeemed at par at the same price to which actually they belong to. Now, like for example, suppose a company needs long-term fund to buy machinery. In order to raise long-term fund, company has to incur flotation costs, that is brokerage, commission and advertising. So for that purpose, it issues a commercial paper. So that's about commercial paper. I hope the topic money market instruments is clear to all of you. You'd say, ma'am, here it's raising fund, you're saying it raises funds for seasonal or working capital needs, and also you're saying that it raises funds sometime for flotation cost. This is an exclusive feature and this is the major purpose. Usually commercial paper are for short-term funds, but sometimes for meeting the flotation cost also, which can be covered once the funds are raised or the shares are raised. So for that purpose also commercial papers are issued. Of course, highly credit rated companies. Alright students, I had forgotten one point with commercial paper. The tenure of commercial paper is from 15 days to 1 year. This point was left out, so I have just covered it up. We talk about meaning out here, purpose, exclusive feature, which talked about bridge financing, example, and then the next point is tenure is from 15 days to 1 year. I hope it is all clear about the money market instruments, the various instruments which we have done. Next video we will talk about the capital market, the primary and the secondary market. Till then, bye-bye.